the biggest contributor to the big heavy inflation that we had a few years ago was really because of the government spending in reaction to COVID.
States' budgets have ballooned because, like everyone, when the money's there, they spend it, they light it on fire, but now the revenue's not coming in.
These are marketing strategies. These are strategies to sell more life insurance to make more commissions.
Your life insurance as an entrepreneur, if you buy one of these permanent life insurance policies, may make more money on your policy than you ever will.
They get indoctrinated into thinking that this is the greatest thing ever. And, it's just a tool. And it's a tool that gets misused probably more than any tool that I can think of in financial services.
And I thought today would be interesting for us to talk through the power of our own inner circles. Jim, welcome. We're back again. The Make Rich Real podcast.
Thank you, Bryce. Good to be here.
Yeah, you look good. You got a nice little haircut.
Thank you. Yeah, Mimi said it makes me look like an old man. I was like, honey, that's not very complimentary.
Why does it make you look like an old man?
You'd have to ask her. It's that, what? I could never say that to her.
No.
But she can say that to me.
Well, she never looks old.
She never looks like an old man for sure.
Yeah.
No, that's true. She never looks old.
Well, I don't think you look that old. I think you look age appropriate. You look healthy.
Thank you. I will take that. I'll take that all the way to the bank.
Well, one thing that's not healthy, this is actually a great transition, state balance sheets. So we're going to jump into state balance sheets. States are broke, cities are broke, and they're coming for our entrepreneurs' wallets. So every entrepreneur who's paying six figures plus in taxes needs to know some of this information. So we're going to jump into that. Then we're going to dive into something that I know you're really passionate about: overfunded life insurance, bank on yourself, the permanent life insurance policies, the pros and the cons.
Never heard of it.
Yep. So we're gonna go into that. A lot of our entrepreneurs are pitched that. It's a very oversold solution.
Yep.
And then we're going to wrap up talking about just the power of networking groups and the power of just being in the right social circles. I know you and I both are in different entrepreneur groups, and it's been awesome for both of our developments and ongoing learning.
Absolutely.
All right.
I need a lot of development. So.
Yes.
Yeah.
Yep. Well, you're an old man at heart, I guess,
I look
or
like
not at heart.
I have an old man haircut.
Yep. All right. Well, let's start here. So, coming out of the pandemic, which is 2020, at that point in time, the states were flooded with cash because the Fed was printing money and pushing a lot of money to states, and the state general funds have declined across the board in 2025, and it's the first time since 2011. So state budgets are not doing very well, and it's because, again, this federal pandemic aid has completely dried up, and with the One Big Beautiful Bill Act, Medicaid and other federal supported really income streams have disappeared, and then also tax cuts, which are now been extended to the One Big Beautiful Bill Act, we're going to talk about that, are also decreasing the revenue side. So states' budgets have ballooned because, like everyone, when the money's there, they spend it, they light it on fire, but now the revenue's not coming in. So a table that we're going to put up here, some states that are in distress. So New York, they've got a $34 billion cumulative budget gap over the next 4 years. So Mamdani just came out and said specifically New York City has a huge shortfall that he's working through and wants to increase some taxes on. Illinois, $3.2 billion deficit in 2026 alone, growing to $5 billion by fiscal year 2030. So that's annual. Washington State, $12 billion over 4 years, and California just has what we're calling a structural deficit. So a lot of questions on California's true deficit and gap because they're not marked to market on their pension liabilities, and there's some claims that could be tens of billions of dollars of pension liabilities that are not, again, getting marked to market. So a lot of issues here. Balance sheet's not looking good.
Dum.
What are your thoughts here? If you were governor of a state for a day, how do you start fixing these problems?
Yeah. Interesting. The biggest contributor to the big heavy inflation that we had a few years ago was really because of the government spending in reaction to COVID. And there was way too much government spending. And then what did consumers do with the extra money? They spent it. What did states do with the extra money? They spent it. And the biggest problem with any government is that they end up spending and not thinking about the future. And unfortunately, the way people get elected in this country is based on what can you do for me today, not what is the country going to be like or what is my state going to be like in 10 years. I don't know how we fix that, but definitely there's no fiscal oversight and there's no financial responsibility to a large degree in the states you just mentioned and in the federal government. I've always criticized both parties for not really being financially smart and financially fiscal. And when you overspend, there are ramifications. One of the good things about the states is states are limited because at some point they run out of money, and that's where we're seeing these problems, whereas the federal government can print more money. So we can kick the can down the road as a government federally much easier than as a state. So back to your question, what would I do if I was running one of these states? Well, the first thing you have to do is get out, sharpen your pencil, and start cutting costs, because you cannot tax your way out of these problems at this magnitude. The only way out is by cutting expenses, which is the one thing that governments and bureaucracies resist with every fiber in their being, is to cut expenses. But that's the only way. And we'll talk a little bit about taxation, but taxation also reduces economic growth, and taxation, you end up, especially in states, people leave your state if you tax them too much.
Yep. Well, you hit the nail on the head in terms of what are all these states doing, or cities. They're going to increase taxes. And so California is really coming out with the first billionaire tax, or the wealth tax, which is going to be a very interesting first of its kind proposal. And what's interesting is this would be a one-time 5% wealth tax on the 255 or so billionaires that are in California, and it was retroactive to January 1st, 2026. So if it hits the ballot, it needs to get the signatures to get the ballot, then it needs to pass in November of 2026. It'll be retro to January 1st, 2026. So already Peter Thiel, David Sachs, there's a lot of billionaires, the Google guys, they left also to get to Florida or Texas, or just to get out of California, because obviously paying 5% of your wealth on things that are most likely illiquid or not easily marketable is very challenging. And one thing that makes this even more interesting is like why the Google guys would have been really penalized even more is that if you have voting shares, you multiply that by 5 times. So it could be up to a 25% tax on your voting shares. And since the Google guys have the super voting shares, it would have been 25% is my understanding on the value of their Google stock, which is just asinine to think about. And that's why they had to get out before 2026.
Yeah, there was a lot of moving happening in December of last year. It's amazing that this is actually potentially going to pass, because to me, when you look at the Constitution, not only the federal government, but of the states as well, this looks like they're absconding with people's property. I mean, that's what it looks like. Mm-hmm. And there's no way, if you study the founding of our country, that the founding fathers would have been okay with someone just saying, hey, you have a lot of money. We don't have enough. Let's just go take some of yours. And that's what it really is. It's not like income tax that was passed in, what was that, 1912 or 1913, 1914? It was one of those years. Early 1900s, before that, no one was income taxed in this nation, and that also would have been against the framers of the Constitution. However, it's been pretty clear that you can tax things like income, you can tax things like capital gains, but it's hard to tax things that have not had a taxable event. You know, you just have all this property, you're not selling anything, and then all of a sudden you have to pay a tax on your net worth. It's hard to believe, and definitely the billionaires have spoken and said that this will be in a long, drawn-out court battle if this passes and if they try to extract this money from these billionaires.
Yep. And California's already at 13.3%, highest marginal rate, up to 14.4% if you make over $1 million through like W-2 and earned income. So they're already at the high end of the scale.
Yeah, if taxation worked, why wouldn't the highest tax states have the best financial condition in their state? And they don't.
It's interesting. I mean, but not to outdo California, New York with the new mayor, Mamdani, which is controversial, right? Him pursuing socialism here. He's got a $12 billion budget shortfall. He wants to increase New York City's top income tax rate from 3.9 to 5.9. So this would be those top earners. And that would combine state and city, put them at 16.8%.
Wow.
Slap that on top of a 37% federal bracket, and you're now about 54%. Now, that doesn't include your payroll taxes. So if you include your payroll taxes, you're over 60% of those wages are going out the door in taxation.
And it's also not including property taxes, sales taxes, gas taxes, everything else you pay. If you added it up, those doing very well business owners, which is who we serve, they could be paying 70, 75%, 80% of what they make through all the combined taxes that they pay, which is, it's disturbing to see that.
Yep. And so we got a chart here we're going to put up. This data is from 2023, but it stays pretty true. But less than 1% of New York City filers, which is those earning over $1 million per year, which is the millionaires, the green part of the pie here, they pay 41% of the total taxes. So less than 1% pays 41% of the taxes. All other taxpayers make up 59%. So there's sometimes talk about the rich don't pay their fair share, or we do not have a progressive tax system, but I think those are just political narratives, and there's numbers that substantiate that's not the fact when less than 1% are paying 41% of the taxes.
Absolutely.
In New York City
well,
here.
Federally, about half of taxpayers pay zero.
Right.
And then you've got the top 1% pays about 40%, the top 10% pays about 60%, the top 25% pays about 90% of all the taxes. That's pretty close to the numbers. They vary a little bit every year. And that's where, I always say for high income earners, when people say they don't pay their fair share, no, they pay way more than their fair share if you're looking at it from that perspective. And at some point, the people who drive the economy and create the jobs should be allowed to keep more of what they make and stimulate the economy.
Yep.
Just my thoughts.
Yep. Well, hey, if you're in this high tax state, these high tax states, the state and local tax burden is likely going up, not down, because those states are being mismanaged. And I think the other piece is the value proposition of these high tax states is eroding very quickly. New York City found that only 34% of New Yorkers rate quality of life as good or excellent. So why, at a certain point you ask, why am I paying such premiums to live in a place that maybe doesn't have the same quality of life as you once had? And I think it's interesting if we extrapolate this out over 3, 5, 10 years. I remember several years ago, really pre-COVID, we had a substantial amount of entrepreneurs, clients that were in California. I know of one that is still in California. Everyone else has gone to Florida, Nashville, Phoenix, Scottsdale, Austin, right? And it's not a coincidence they're flying away from those into lower tax states. And also, I think, obviously, given the situation of COVID and the lockdowns, that was a big forcing function. But I feel like the trend's already there. The money, the jobs, now they're kind of going to be gutting the billionaires and all of the job creation. And now if you're an entrepreneur and you're taking on venture capital money, do you want to build in the Bay Area, right? Because if you know that if you do hit it big, you're going to then now start having to pay allegedly 5% one time, but we know that that's just the start, and they're just going to keep coming back and lower the amounts. It's not going to be the billionaire tax; it'll be the 100 millionaire tax, and it'll be the millionaire tax, and it'll be the you have over 100 grand tax. So I think it'll be very interesting to see the haves and have-nots over the next 5 to 10 years, and this could be like a boom for Texas and Florida and some of these other business-friendly states.
Absolutely, already has been. And when I meet an entrepreneur in California making a lot of money, let me do your tax planning. Number one, move.
Yeah.
That's like the easiest thing you can do. And unfortunately, higher taxes don't mean better fiscal responsibility. It reminds me of, if someone's kid runs up a credit card bill and then comes home and says, let's say a 25-year-old, Mom, Dad, I ran up this credit card bill. Will you pay it off? And they do. Guess what happens a couple years later? Kid comes back with another huge credit card bill. Because until you're responsible with money, giving them more money is not going to help solve the problem. And that's what the states are doing, just trying to get more money when they haven't fixed the problem of overspending, which really is what's driving this.
Yep. All right. Well, so states are broke in raising taxes, but where it gets interesting is, as we talked about in the past, the federal government passed the One Big Beautiful Bill Act, and a lot of states don't want to play along. And so what's interesting is that just because the federal government hands you a tax cut, the state may not oblige, and the state may not play by the new rules. And this is something a lot of people don't understand, and it's called conformity. And so states get to choose how much do they want to conform with the federal government's tax laws. And in the past, a lot of the states have conformed. And we have a chart down below that we're going to put up here that most states have what's called rolling conformity, which means that they automatically adopt federal changes as they occur. But what's happening is that because of the One Big Beautiful Bill is another tax cut, a lot of states are now looking to actually get out of rolling conformity, and they don't want to apply these tax cuts at the state level. Why would they do that? Because their budgets are in bad shape, and they know that if there's less income coming in, that's less revenue to them. So it's interesting to see, and even here in Arizona where we're at, our governor is already having conversations, and she wants to get out of conformity because, again, she wants to help make sure that the Arizona budget is shored up and increase revenue, essentially.
Yeah, it's interesting, I think, because most people assume that their state is going to follow the federal law, and that's not the case. And they may not find out until they file their state tax return that that's not the case at all.
Yep. All right. And a few things that drive some of these big deductions. So what are some of the big cost drivers? The first thing is the state and local tax, the SALT cap. So that was raised from $10,000 to $40,000. So that's the amount of state and local taxes. Think property taxes is the biggest one here that you can write off. It was capped at 10 grand. Now it's capped at 40 grand so long as you make less than $500,000. So that's going to be a huge boom for those I'd say making 3, 4, up to the $500,000. That's going to hurt the states.
Yeah, and one thing on that, you might want to mention it's down at the pass-through entity tax.
Yep.
I should have looked at these notes beforehand.
You should have, yeah.
I'd sound smarter.
The pass-through entity tax is still around, PTET as we call it. So that was made permanent as a workaround that pass-through businesses, S-corps and partnerships, can pay their state income taxes through their business tax return and still write it off at the federal level.
Yeah, and that was a state reaction. It started small, and now virtually every state that has the SALT issue has that workaround for business owners like S-corps, LLCs, partnerships.
Yep. Some other things that are going to be driving some of these budget deficits here are some of the cuts, 100% bonus depreciation, permanently restored. So we see all these data centers going up everywhere. A lot of, right, you fill those up with the server racks. Those are being 100% expense. So there's a huge boom. It's working. There's a lot of huge GDP growth, and the numbers are crazy. But there's also some great tax benefits behind this. So, President Trump's play is working out there. R&D, you can now fully expense that versus amortizing over 5 years. A lot of states don't want to conform to that because that was a huge revenue raiser for them.
Yeah, Section 174.
174A, yep. And then Section 163J, the business interest expense limitations revert to EBITDA instead of EBIT. So essentially, you're allowed to write off more interest if you're a highly levered company. So those are some of the big things. Last thing I would say is the qualified small business stock. They're not going to feel that in the short term, but 1202 stock was increased from a $10 million to a $15 million exclusion at sale, but people won't feel that for 5 years if they created a new stock after July 4th, 2025.
Yeah, although they get 50% after 3, 75% after 4.
Yep, exactly.
Yep.
So some real impact here to some of these states. So Michigan is projecting $2 billion in revenue losses over 5 years from OBBBA. So they've actually done the analysis and quantified it. So hence why they are looking to stop conformity. Pennsylvania, $1.1 billion in 2026 alone. Delaware convened a special legislation session to address a $400 million revenue loss. Illinois and New York, we already talked about them. They're broke. They're now really struggling here with this too. So a lot of the state legislators had already adjourned when this bill was signed last summer. So just now, a lot of these states are looking to get caught up and then most likely looking to make some retroactive changes starting in 2026.
Yeah. And guess what all those states have in common? Their weather sucks compared to ours right now. Come out for the weather and come out for a better run state.
Yep. All right. So what does this all mean? Again, it's just states looking to raise more revenue. States have bad balance sheets. States increasing their taxation. And again, this goes into kind of what our previous point was. I think there's going to be the haves and the have-nots when it comes to states. And it's going to be interesting that people, I think, are going to vote with their legs and moving. And because I don't see with some of these changes how things are going to get better in these high income tax states in the next few years.
No. And in addition to the spending, we also forget the waste. I got to imagine there's so much waste in these governments. I mean, if you just look at the fraud in Minnesota as just the tip of the iceberg for what goes on in these big bureaucracies, because there's no real reward to get more efficient. And, fraud is one thing, but just the inefficiencies and the wasted money, I bet, is unbelievable. I mean, running our company, we have to look at every line item. We have to be efficient. We have to make sure we're using our money wisely, because if we don't, we go out of business. But the states don't go out of business. They just keep churning along.
Yep. All right. Well, we're going to transition here into life insurance. And I'm excited about this because it's a sad reality that your life insurance as an entrepreneur, if you buy one of these permanent life insurance policies, may make more money on your policy than you ever will on it. And so there's a spectrum from oversold crap to billionaire grade tax shelter. And we're going to go through how you go from one end of the spectrum to the end of the spectrum.
Yeah.
So I know you love this topic, so I'm excited. You can't even help yourself.
I know. I'm interrupting you already.
So I think the first thing is that I wanted to call out is there's a conflict of interest problem, and there's commissions. Because why are there so many insurance agents, and why are they all looking for high-income entrepreneurs that we serve? Is because there's massive commissions. And so on average, if you buy a permanent life insurance policy, so think a whole life or an index universal life or a variable universal life, that the payout or the commission that the agent gets is going to be right around 100% plus or minus on average. It could span from like 40 or 25-40% all the way up to 115%. But said another way, if you put $100,000 of premiums into your whole life policy in year one, your life insurance agent most likely made $75,000 to $100,000 of commission on that day alone when you sign and fund that policy.
Yeah, it's a lot. And of course, these are hidden commissions. So you don't get to see the commission. They don't share the commission generally. And when you have something that's hidden that pays someone a lot, it's an incentive to maybe recommend these things when they're not appropriate. Because life insurance is a tool. It's an important tool. It's a tool that needs to be used, in every plan, whether it's when we did our buy-sell agreement, right? We funded that through term insurance with a period of time. We knew that at some point we wouldn't need the funding to buy each other out if that happened. And yet we see lots of business owners that don't have buy-sell agreements, or if they have one, they're not funded. And, term insurance is cheap. And then even permanent insurance has its place. But boy, this stuff gets oversold, and we see nightmares on the back end of when this is done wrong. And I have to say, in my experience, it's done wrong way more than it's done right.
Yep. And so we're going to put up a table here that shows the different policy types: term life, whole life, universal, variable, typical first-year commissions, renewal commissions, and really the conflict of interest risk. And the big thing for us here is we don't take commissions. We don't take referral fees. We don't take kickbacks. You need a fee-only fiduciary who's in your corner who, because as Charlie Munger always says, show me the incentive and I will show you the outcome. And, when someone has a hammer, everything starts looking like a nail.
Yep.
So let's jump into what these overfunded bank on yourself policies actually are and how they work and how they're sold. And then we could talk about a few different strategies that will build on top of this framework. So,
right. And by the way, bank on yourself is just one of the terms. Infinite banking, cash flow banking, the LEAP program. And one thing that entrepreneurs need to be aware of is these are marketing strategies. These are strategies to sell more life insurance to make more commissions. That's it. Under the covers, you have to look at how they actually work, when they apply to you, and how they can be implemented to your satisfaction, not to the agent's satisfaction. These have been going on for my whole career. For 30 years, I've seen these, and they have always a different marketing twist to try to sell these types of products. But that's what it is. It's a way to market and sell these products.
Yep. And I know, Jim, you were on a nice panel debating these policies on a separate podcast. So how about you tee up how you would describe or how these policies are sold. And then we can talk through some of the pros and cons, what's real, what's not real.
They're sold in a lot of different ways, but the big thing that the big selling point is that the tax benefit of life insurance. So life insurance, the money you put in is after tax. So you've paid your taxes and then you pay the premium, unlike an IRA where you'd get a deduction against your taxes. So it's after tax money that goes in. It grows tax deferred. And then on the back end, you can pull money out tax free if first you pull your basis out and then by taking loans against the policy. So that's the idea behind it. And it is a powerful idea and it can work in certain situations. The problem is the execution and the cost, because these are the most complicated and the most costly products that exist in financial services. In fact, a mutual friend of ours who's a life insurance expert and been doing it for as long as I've been doing what I've been doing, and he said anyone who says that they understand whole life insurance doesn't understand whole life insurance, because it's a black box. You can't see what's in there. You can't peel out the mortality costs, the admin fees. It's a black box. But what we do know is these policies are very expensive and they're very complicated, and they make a lot of money for agents and for insurance companies.
Yep. So I think the vision or what gets sold is, hey, put money in after tax. It's going to grow and compound tax free. And then whenever you need the money, you can just pull money out via a loan. But that loan and that interest is, they kind of say, going back to you. Now, in reality, there's a spread that the insurance company is making. So whenever they lend you money, you are paying interest back in, but there's a spread that they're going to make on it. And on top of that, the historical rate of return in this bucket is around 5.5% is kind of the typical crediting rate. And so you also need to see, like, how is this doing as an investment perspective or as an investment vehicle? Because we should, if this is a pure play investment, which is how it's framed up, the death benefit is sure nice to have, but this is really an investment vehicle. So therefore, let's go apples to apples comparison with other investments, whether it's real estate, crypto, stocks, bonds, private equity, venture capital, and let's compare on an after-tax basis. And then, of course, we need to factor in liquidity needs, etc. But I think at the end of the day, that's a big issue, is that you get locked in and the rate of returns are not very high, and you're underwater for the first 3 to 7 years because those massive commissions are going out the door day one.
Yeah, that's very true. And I've even seen studies that show performance of things like whole life lower than that, 3 or 4% over time. Whatever it is, life insurance is a low return investment. You could say a low risk investment, but very expensive investment if you're looking at it as an investment perspective, that's one of the problems is I'm not sure I'd categorize it as an investment. It's a insurance policy. It has a death benefit. And if you use it for accentuating or diversifying your portfolio, you have to be very smart at how you do that. One thing about life insurance in general, and when we take it whole life, for example, because sometimes I've heard insurance agents say, well, term insurance, the death benefit never pays out, which is true. Very few term insurance policies pay out. Why? Because the insurance companies are good at underwriting them to know that you're probably going to die before the end of the term, so they don't have to pay you out. And then a lot of people might cancel their term policies when they don't think they need it anymore. On the other hand, whole life insurance, believe it or not, permanent life insurance, something like 80% of those, and there's a few different studies you can look up online, 80% of those never pay out because people cancel them before the death benefit. Why? They realize that maybe the structure wasn't done correctly. They overpaid. The money's not growing. They have friends that tell them that's not good for you. You need to get rid of it. For whatever reason, there's a myriad of reasons. When people say this is such a great thing for entrepreneurs, when you look statistically, a vast majority of entrepreneurs that buy life insurance, permanent life insurance, don't get all the benefits that they're promised at the beginning, whether it's because of their behavior, surrendering the policy, or because of the policy being designed poorly or putting too much in the policy. Because the other thing that I see is the entrepreneur will have, let's say, $20,000 a month of disposable income that they can invest. And the insurance agent says, oh, you should take 10 or 15,000 of that and put it into a permanent policy. So you also have to remember that this should come not as a huge part of your portfolio, as a smaller part of your portfolio. And the death benefit should be the number one and most important decision that you made. Because if you don't have enough death benefit to protect your family, that's the biggest concern when it comes to life insurance that I see.
Yeah. I mean, I think you buy term to get the death benefit. That's the cheapest way to get the death benefit. Align your term to when you're going to be financially free. Once you sell your business, have your liquidity event, you don't need the death benefit anymore. So you should cancel your term policy, right? It's an insurance policy, you know?
Although there are times when you want a death benefit to go all the way to the end, and that's where you can use things like second to die policies that reduce the mortality costs. That would be estate taxes happen at the second death, so that times that well, cuts down your costs. It could be a guaranteed universal life policy. Mm-hmm. Those now will guarantee to age 120 or even longer, so you get kind of just paying for the insurance piece and not worrying about the buildup of the money. If you need the death benefit at age 100, term isn't going to do it,
right.
But there's other ways to get it that much cheaper than the traditional, whether it's UL, VUL, whole life, or index UL policy that you're being sold to overfund it and to, create all these tax benefits.
And another problem too is, like you said, if you see an entrepreneur, one of the few cases where I do think these permanent policies make sense is an entrepreneur who wants to create that liquidity at death. And so generally it's going to be at a second to die policy. Usually you're going to always want that in an irrevocable life insurance trust because you don't want that in your taxable estate. Because that's another big problem is that even these people who are sold, maybe it's a $500,000 a year premium 7-pay policy, the death benefit's $25 million. Well, if my net worth was $20 million before that, if I actually do die, I now just created an estate tax problem. Yep. And that's in my taxable estate. So when I get the death benefit, I actually have to pay estate taxes on anything over $30 million.
If you're married, yeah.
If you're married, exactly. So that's another huge problem that they just kind of ignore. They try to, when it's convenient, say, oh, yeah, we get the death benefit. But it's like, well, you're also now creating an estate tax problem. So another situation where I do think putting a small part of your free cash flow into a permanent life insurance policy, whether it's whole life, IUL, or VUL, is when your balance sheet is so large that just the passive income that you literally just wake up and just the passive interest and income is going to always keep you in the highest tax bracket. Because I think then there's an argument to be made that this is a hedge against increases in tax rates. And so we're talking about how at the state level that's happening, but then at the federal level, it could happen too, right? Tax rates go up and down. So this could provide a tax hedge that, hey, I'm putting after-tax money in. And if I think tax rates could go up in the future, then it may make sense for me to have a hedge or another bucket, kind of like a Roth, that I can pull out tax-free. So
that's a good point.
That's another bucket where I think that for clients that are really above maybe $15, $20 million liquid, you tend to kind of be in the top tax bracket for the rest of your life just because things make money, that you're invested in. That's when, okay, hey, maybe it makes sense to carve a little sleeve out into these policies purely as a, yes, lower return, but tax bucket diversifier.
One thing that's interesting about permanent life insurance is when you're younger, the costs inside the policy are a lot lower, your mortality costs and everything else. So a lot of insurance agents are like, plow money in there when you're young. However, when you're young, you have the longest time horizon. So you can afford the most risk. And if you compare a permanent policy to stocks, real estate, private equity, the things that will give you much better returns and compound your money over time, you're better off investing in that when you're younger, not when you're older. So it's kind of interesting because, yeah, your mortality cost is lower, but that's the time when you should be investing your money in the high risk assets like stocks, real estate, private equity, all those types of things, because you have so long and it's going to so dramatically outperform a permanent policy over 20, 30, 40 years. The amount that you'll have is so much different. And then you can manage the taxes. You can buy and hold, you can use low cost, index funds and things like that. So that's another problem is I see entrepreneurs sometimes, they're 30 years old and they're putting 80% of their disposable money into a permanent life insurance policy, and they're missing out on stocks, real estate, private equity, and all the things that are going to really grow their wealth from 30 to 60 or 30 to 50. And that's a problem that I see all the time.
Yep, just spot on. All right, let's transition into premium finance.
Before we do,
yeah,
one more comment, and that is everything that we do in our practice is what I learned from a billionaire family in New York, and billionaires buy these types of policies too. One thing they never do is they never buy a policy without representation, with someone who knows the life insurance as well as the agent selling it, but doesn't get a commission, doesn't get a reward, doesn't benefit in any way, whether they buy the policy or not. Every billionaire family has someone on their team who knows those policies when they shop for those policies to protect them and to negotiate down the commissions, and also to structure those right and make sure that it's actually going to serve the entrepreneur more than serving the agent and the insurance company. So always have representation from someone who knows these products but doesn't benefit from you buying these products.
Good disclosure. Okay, let's talk about premium finance permanent policies. So we talked about permanent policies, whole life, IUL, VUL, which stands for index universal life and variable universal life. Now we're going to talk about premium financing, so ways you can borrow money to really overfund these policies. So this is just taking this strategy and adding on leverage, or debt, which always amplifies risks and return potentially.
Yep.
So we saw a lot of this in 2020 through 2022, because if you remember at that time, interest rates were at essentially 0% as we were coming out of COVID. And a lot of these policies are going to be based off of SOFR, which is a floating interest rate. And then it's going to be SOFR plus 2 to 3%. So you were paying maybe 3-4% interest. Now, if the market, and if most of these are in IULs, which are going to be tracked to the S&P 500, usually with a floor of 0 and a cap of 10. So over a long period of time, maybe you get 6% or 7%. So if you get 6% and you're paying 3% on the interest expense, because I'm borrowing money from the bank, then I'm arbitraging that 3%. So it really works out well. But when interest rates start going up, 23, 24, 25, and now we're around 2026, now it's 6 to 7, 8%, right, with the SOFR plus the plus a few points. That arbitrage has not only gone away, it's reversed, and now you're underwater. And some estimates suggest that up to 25% of all IUL annual premiums are financed. So that's a huge exposure, because right at this point in time, would you borrow from the bank and pay the bank back at 7%? If you can get, credited between 0 to 10%, right? You're gambling. And so what happens is when it goes wrong, you have to do a capital call. You need to put more money in. And so then I know we've seen entrepreneurs that have come to us with these plans, and every single one has been unwound because maybe it worked for a few years, but then the writing's on the wall when the interest rate environment changes. There's just not enough juice here, and they're just get frustrated. Capital call, putting more collateral up for the bank.
Yeah. And I've seen these when they can work. The problem is often the commissions are high. Often the structure of the policy is not done for the benefit of the entrepreneur. And they often don't understand the risks that you just talked about. Because when you're borrowing to invest, as you said, it accentuates both the risk and the return. And when you're doing something with a conservative policy like this, if your returns are below the interest that you're paying, you're upside down in the policy. So this also, because these premiums can be huge, the payouts can be huge. I remember I looked at one a couple of years ago, and I was able to figure out that the agent made $600,000 commission on that premium financing deal, and the client didn't really understand what they had. So be careful of all things, but especially premium financing, because the commissions are so big and the risk is bigger because of the lending, that if you don't understand these things, you could really get in something that causes a mess for you in the future.
Yep. And the whole story here is, hey, you put in $1 million a year, you borrow that $1 million and you pay the bank 5%. We'll get 7% rate of return on average. So that's an average arbitrage of 2% per year. Keep doing that for 10, 15 years. And at a certain point, we've got enough money saved up in the vehicle that we'll actually take a loan out from the policy, go pay the bank off, and then now we have a loan, within the policy. We can stop paying in, and you got free insurance, right? And you kind of arbitrage it. That's the story. That's the narrative. Like you said, there's massive commissions, but these blow up. And so Oklahoma State had they borrowed $16 million to premium finance policies on T. Boone Pickens and other famous alumni. This was back in 08, 09. They ended up paying $33 million total in borrowed premiums, and then the market collapsed coming in 08, 09. And there's rumors that they ended up, because they had to put up so much more collateral, that they lost across the board with all of these different donors $282 million from this. So this is where, right, it's like leverage. When things go wrong, they go wrong very quickly. So
what's interesting about it wasn't T. Boone Pickens that had that policy, right? A lot of times when I hear life insurance pitched as this grand idea, they talk about like all the rich people are using this magical thing. And of all the rich people I know, they generally don't use debt for life insurance. They'll use debt on multifamily real estate. They'll use debt on certain things. But generally, they only use debt in a situation where they feel that they understand the risk, they have enough collateral, they have enough safety, and they usually don't even do it on their primary residence. You can deduct that, but they usually don't have much debt. And that's how they survive all the hard times, is not having debt.
Yep. Yeah, it was Oklahoma State that was doing these policies on the alumni.
T. Boone said, I'll pee in a cup. You can take my blood. No problem.
Yep.
But I'm not giving you the money to fund the policy.
All right, now we're going to talk through private placement life insurance, abbreviated PPLI. This is really the billionaire's tax wrapper, and PPLI is going to be fundamentally different because it's really not about the insurance. It's about the insurance wrapper. Because as we talked about in the very beginning, any of the assets and the growth in the insurance wrapper is tax-free. So what some billionaires do, or what private placement life insurance allows you to do, is put tax inefficient investments, think hedge funds, things private credit, these things that create a large tax liability every year. Well, you can put those in your own life insurance wrapper, which allows it to grow and compound tax-free. So it's just a way for us to really grow and compound our tax-free wealth. And instead of paying large upfront commissions, generally you're going to pay 1 to 2% of total fees. And then usually there's going to be some maybe 3 to 4% upfront premium fees. So a little bit more on an ongoing basis in terms of the fees, but you're not paying 50 to 100% of the upfront premiums and fees, which means that your cash surrender value and your account balance is a lot higher in those first several years versus an off-the-shelf product.
And this really came about because billionaires said, hey, we like that tax-free wrapper. We just don't like the insurance agent. Because what happens is no commissions. It's a fee product, so it's transparency. They know what they're paying. There's no surrender charges. I mean, you might wonder why, if you buy a permanent policy, if you surrender it a year or two later, you don't get any money back. It's because they have to recoup the commissions they paid the agent. So there's no commissions. There's no surrender charges. It's a fee, transparent fee. They know what they're paying, and they get the benefit, the tax benefit of the tax-free growth within the portfolio. They can't manage the money themselves, but most billionaires don't manage their own money. You have to have an investment manager of the portfolio. But like you said, things like venture capital, private equity, things that have a lot of negative tax impact, they can put it in that wrapper and avoid the taxes.
Yeah, and where we see a lot of this too is when you have that dynasty trust, you can put a PPLI policy that's going to be owned by the dynasty trust. So then when the matriarch or patriarch passes away, the death benefit is then paid out in cash in the dynasty trust. There's no estate taxes. And then you're also not creating an income tax bomb every year because all of the investments are accruing within that life insurance wrapper. And similar to the other policies, you can take a loan out using the life insurance as collateral. So
yeah, and since you went to the little more advanced, things like IDGIT's intentionally defective grantor trust, where you might have an estate plan where you've got money in this IDGIT. And the reason why it's called intentionally defective is because, as you know, the taxes are not paid at that level, which is a future generation. They actually filter back to the grantor, the mom or dad who created it, where they pay the taxes, which is good because you're taking money out of their estate. However, often the grantors get tired of paying the tax. They're like, we're paying the tax every year for this IDGIT, you idiot. And then what they do is they put that in a PPLI wrapper so that there are no income taxes that flow back to the grantor. So that can be a great solution for an advanced strategy like an IDGIT. I think that's what they say in Ireland. They call you IDGIT. IDGIT.
Oh, I love it. All right. Well, we're going to put up a chart here of the spectrum. So where do the policies fall? Different strategies, the overfunded whole life, the premium finance IUL, the private placement life insurance, and just some comparison metrics here. So when you as an entrepreneur, when your life insurance agent's making $100,000, plus commission on your policy, ask yourself, is this my retirement or your retirement that we're funding? So, all right, now that we've laid out the spectrum, let's go through an actual case study to show what this looks like in practice. These are actually real numbers here from a client that we helped who was sold a really bad policy and some of the things that we changed. So, same client, same health, and these different scenarios we're going to go into, same premium, but by changing how the policy was structured, able to change the commissions reduce the commissions by $89,568 and generating $79,025 in incremental year one cash flow. And more importantly, added $907,920 in additional tax-free income over 20 years. So this was a client that came to us. They were being proposed an overfunded whole life policy. Then before they actually signed the paperwork, we had people that we trust that max blend their commissions and that set these up in a fiduciary way. Take a look at it, and there were some massive changes here. So let's go through the 4 pillars of buying life insurance like a billionaire, Jim. So how about you take us all through those 4 steps?
Sure. So the first is underwriting. And usually what happens when an entrepreneur buys life insurance is the agent shows them a proposal, presentation. And by the way, the illustrations, I can tell you, are 100% never true. I've never seen an illustration 30 years later that actually came true exactly the way it was proposed. So they see an illustration, they get pitched the idea, they like the idea, they buy the whole life, and then the agent puts one application with one provider because it's best for an agent to work through just a small number of providers. That way they get trips, they get better commission schedules. It does help them know the product better. But you'll typically see an agent that's really making their living off commissions will just sell 1 or 2 or maybe 3 products. So then it goes off to underwriting with one company. Whatever the underwriting comes back is how they put it into force. And the problem with that is the underwriting of the policy stays with the insured for the life of the policy. So it's an enormous difference if you got, let's say, standard versus preferred or preferred plus versus preferred. Those make an enormous difference in the cost of the policy over the lifetime of the policy. So what billionaires do and what we recommend and what we do with our clients is shop the different companies because different companies have different underwriting for different circumstances. And so the best way to do it is you take the entrepreneur, you take a application, you get the blood, urine, EKG, whatever you need to get for that size policy. You send it to 14 different companies as an example. You put John Doe and Jane Doe on the applications. They have all the medical testing. It's the actual person, their blood, their urine, everything else, all the test results, and then they come back with their offers. And you get them pitted against each other. And you'll see that typically if you do 14 different companies, you'll get 2 to 4 different levels on the underwriting. And just 1 or 2 differences on the underwriting conclusion can make a huge difference on how that policy functions. So then when you come back, you pick the one that works best. It's already been underwritten, and then that's what you would put into force. That's the underwriting. Blending, this is probably the most impactful thing because we've already talked ad nauseum about the huge commissions in life insurance. So this is really negotiating down the life insurance commissions. And what a lot of entrepreneurs don't know, a lot of people don't know this, is that commissions can be negotiated. They can do what's called blend the policy with non-commissionable insurance, which reduces the amount of commission paid. And I've had people say, no, you can't do that. I've had insurance agents tell me, no, you can't do that. And I say to the insurance agent, well, maybe you can't do it. But there are insurance agents that can do it and will do it if we're going to work with them. Number 3 is the internal charges, the cost of insurance, admin fees, surrender charges. Those change between carriers, so you also want to look at that. Lower internal charges means more of your money working for you. And then 4, the investment choices. Are these sub-accounts? Is this a dividend paid by the company? Is it an interest rate that's declared by the company? Is it a cap with a floor that we talked about earlier? Understanding what are your investment choices? What does that look like for your long-term performance within the policy? And those are the big 4 when it comes to actually putting together a policy that's going to work for you rather than working for the agent and for the other insurance company.
So putting this in practice and tying those 4 different variables back into this example in this case study here, we'll put a chart up here that's going to show you 4 different variables. So there was an unblended policy, and then there was the blended policy that we drove through our providers that we recommend. Again, we have no compensation. We have no skin in the game here. But the agent commission was going to be $112,600. Instead, the agent got paid $23,032. So that was an $89,000 difference, 80% reduction in agent commission. So what does that do? That impacts the cash value year one. So in an unblended policy, as you mentioned, the life insurance company said, well, I already paid this agent all of this money. I got in $100,000. I paid out the agent $112,000. There's no money here for me if you want to walk away from the policy. Whereas when it's blended, well, since a lot less money went out the door to the agent commission, then that means there's a lot more cash value year one. So you can see that represented from $0 to $79,025. And then where this gets really powerful is tax-free income, because this entrepreneur was designing this as a tax-free pension. So they wanted to put money in every single year, let it grow and compound, and then maybe at some age, let's say 65 through age 85, pull the max amount out via a loan, which is not taxable, and then they'll never have to pay that loan back because the death benefit will pay off the outstanding loan at their death. So in an unblended policy, they would be able to pull out $277,000 per year versus $323,000 in the blended policy. So that's a difference of $45,000 per year of after tax-free money, right? So that's a substantial amount. And if you just aggregate this together over 20 years, which is the last row we've got here, it's an incremental $907,000 of after-tax money. So a few simple tweaks. You go through that 4-step process that you talked about, but the difference here, and this was an entrepreneur that was going to put $100,000 a year into the premium, and again, was going to walk away with almost an extra $1 million of after-tax cash in their pocket when it's all said and done.
Wow. Amazing. One other comment as I think about this whole life insurance thing. You really want to make sure that whoever you're working with, if you buy life insurance, that they're going to be around, or somebody's going to be around, or their company's going to be around. And here's why. A lot of entrepreneurs don't realize that if you take out your basis, then you're taking loans against the policy. And let's say you do that when you're age 30. Let's say when you're age 80, that policy collapses. All the loans you took out for all the years are taxed in that one taxable year. So you might be an 80-year-old that gets a big surprise when you go to see your accountant and do your taxes the next year. So that's why these things have to be managed carefully and watched, and these have to be reviewed on a regular basis. And often I meet entrepreneurs and they have a permanent policy. They put a lot of money in it. I say, when's the last time you talked to the agent? Oh, I haven't talked to the agent in 10 years. That's a problem, because these things can blow up way down the road and cause a huge tax problem.
Yep. All right. Well, we hammered the whole life, the permanent life policy. So let's transition here, and we're going to wrap this up from the fractional family office floor, which really just talks through some of the stuff that we're doing. And I thought today would be interesting for us to talk through the power of our own inner circles. And so one thing that struck to me is actually this morning I was talking to someone who's applying to join YPO, the Young Presidents Organization that I'm in. And when I asked why, the reason was I'm lonely, and I think that that's a true statement that you feel probably, I don't want to project, or that I do feel, that when you are running a business as an entrepreneur, as a business owner, when you're at the top, it's kind of lonely, because yes, you have friends, but oftentimes your friends can't relate to the same problems, the same situations, the same pressures, or competing demands that you're going through. So I'm in YPO, you're in Tiger 21, and I know we both believe that every entrepreneur needs to find a room where they can be completely honest, transparent, confidential, and not be judged, and then also be understood by kind of their tribe. So walk me through your journey of how you found Tiger 21, and I guess how the experience has been for you, and why you think it's so important to 7 to 9 figure entrepreneurs who maybe haven't found their group or think that they don't need to find that group.
Yeah, and I'll take you back even farther. I remember there was a time, because I'd go to all the financial conventions and stuff like that, and I just felt like a lot of people in finance and in financial advisory work and stuff like that, they're not entrepreneurs. Often they work for other people. Often they're just not entrepreneurs. And so I felt, and Mimi, my wife Mimi, our co-founder, felt like we want people who are business owners like us that we can hang out with. And so we started searching, and luckily one of our longtime clients is Joe Polish. He runs a great group called Genius Network. So we joined Genius Network, and all things have kind of stemmed from there. So we realized that hanging out with other entrepreneurs, first of all, a ton of great ideas that I've taken from that group that brought to the business that have made a big difference in our journey. And then that also got me involved in other groups. So, today I'm involved in a group called Wellspring, which is a lot about my faith as a business owner. That's a really amazing group. And then Tiger. So there's a lot of groups I've been with along the way, and they've all served their purpose. So it's not only business ideas and learning from others, but it's also being with your tribe. And one of the things about us as humans is we feel uncomfortable if we're not with our tribe. And my tribe is entrepreneur business owners. And so that's where I started looking for where can I find a local group that are with people who are just like me. In Tiger 21, I know several people in Tiger, and started investigating that. And then you actually introduced to our chair of the group that I joined. And I have to say that the Tiger group, I was a little worried that maybe I didn't fit in, maybe I was different. And I think that's normal when you join a group. But I feel like that room, they're my people. Like, we're through very similar histories. We've all built businesses, sold businesses, gone through the ups and downs of that in life. And we also have challenges that many people, some of my closest friends, don't have. They don't have the asset protection challenges that we have, don't have the insurance challenges that we have, don't have the, how to spend your free time and travel and all these things. One of my Tiger friends just sent me this resort he stayed at in Africa that's like unbelievable. And that's like a cool thing. I wouldn't share that with some of my friends who would just look at me like, yeah, great, you could go do that. I can't do that. So it's been tremendous as far as just network and friendships and connections and learning and growing. I mean, one of the things that is most important to me, and I know you share this, is just learning and growing, taking a beginner's mindset to what's going on out there, so we can all learn and grow. I know I've talked a lot about that. Why don't you tell me your whole thing with YPO? Because I know you've gotten a lot out of that group. I know a lot of YPOers, and I have to say, you being in YPO is kind of me living through you a little bit, just because when I was at the age I could be in YPO, our company wasn't big enough. And then when you took the reins as the managing partner and we're really running the day-to-day and doing things like preparing for the podcast so I don't have to, it was a great opportunity, and you're just such a great fit for YPO. But tell me about your journey and how you decided that would be a good thing and how that's worked out for you.
Yeah. So with YPO, Young Presidents Organization, as you alluded to, you have to be under 45 years old. So that's one of the cutoff criteria. And you have to be running the business. So CEO, managing partner, equivalent, running the business, and there's certain size thresholds. So it's not just anybody running a business. There's certain revenue that you have to hit or valuation, just to make sure the room is, you want to make sure you have the right people in the room. And so I think for me, the biggest thing was that was the first time I've been in a room with entrepreneurs or business owners or operators that feel the same pull in terms of the different challenges of life, of balancing fatherhood, balancing taking care of yourself personally, your health, balancing running a business, obviously, all the different facets that come with life. Sometimes it's not as relatable to your college buddies or other people because they have different challenges, but maybe challenges that you can't relate to as much, and you have challenges that they can't relate to. So going into forum and just being able to have open and honest conversations, and with everything is so confidential, it just is kind of like a therapy session, right? And then that naturally gets you really close to these individuals who are all high achievers doing amazing things. And it also expands your network very rapidly because you meet all these amazing people that have great connections. And then you have great events, like you always have top tier events, which also makes it more fun to show up and just build relationships. So, I can't speak highly enough. It's been an awesome experience. And I think, like you said, it just comes back to like finding your tribe and finding the people that you can kind of really spend time with and open up to and just build, genuine connections with.
Yeah. I mean, if I talk to a really good friend of mine who's making $80,000 a year doing a W-2 wage, I really can't talk about the business the way it makes sense because it just doesn't make sense to him. And certainly if I'm whining like, oh, they just increased the premium on my $10 million umbrella policy, right? He's not going to have any sympathy for me. He's not going to understand.
Yep.
So that it's really been an amazing thing for me. And I'm really excited to see how you're getting a lot out of YPO. Because so both those groups, I'd say Tiger 21 and YPO are two of the most prestigious groups. And so far, that's what I've seen. Very impressive people.
Yep. And we got a chart here, a little table that we also put together we can throw on the screen that just breaks down some of the more popular ones, YPO, and kind of who it's best for. Tiger 21, EO, that's another great one for you have to be a founder in EO. And then Vistage, which is another one that's also out there. So at the end of the day, net worth doesn't buy you a support system. You have to build that. Yep. And, I think some of the best investments we've made is joining groups such as these.
No doubt. And, YPO and Tiger 21 have a very high threshold. So there's a lot of other groups out there. As I said, Joe Polish's Genius Network is a great group. Wellspring is a great group. There's a lot of other incredible communities that you can be a part of if you're an entrepreneur. If you're not an entrepreneur, find your tribe. But if you're not an entrepreneur, I don't know why you'd be listening to this call. This would be very boring if you were not.
Yep. All right. Well, that's it for this episode of the Make Rich Real podcast. As always, we wrap it up. Biggest takeaways. So, Jim, where are you going to finish us off here?
Boy, I tell you what, I really think the life insurance is such a big deal for entrepreneurs, and often they get indoctrinated into thinking that this is the greatest thing ever. And, it's just a tool. And it's a tool that gets misused probably more than any tool that I can think of in financial services. So just be careful and have representation whenever you're making that decision.
Yep. I think for me, the issues with the state's budgets is going to be very interesting to see play out, because unlike, leaving the country is very difficult, and surrendering your citizenship, but moving states is not that challenging, especially the higher income you are, generally the more flexibility you have. Now, that's not always true if your business is landlocked, if you're in manufacturing or something, but I think it's going to be an interesting case study to see. The states are going to try to tax their way out of this problem, and how much are they going to be able to tax their way out of this problem versus how much is it going to turn into the haves and the have-nots. And I think that if I'm a state like Texas or Florida or, Nevada, one of these business-friendly states, I think I'm licking my lips, and I'm starting to put billboards up in California and Washington and Illinois and all these different states and just recruit the high income earners, the business builders, and come build out here, and I think that I don't know, I'm interested to see the difference in states' budgets here over the next several years.
Yeah, it's going to be interesting.
Yep. All right. Well, that's all we got here, Jim. As always, pleasure is mine.
Nice to see you. Glad you like my haircut, my old man haircut.
Thanks for listening to the Make Rich Real podcast, where $1 million businesses meet billionaire strategies. Please note the following disclosure. This podcast is provided by Do Wealth Management, an SEC registered investment advisor. Registration with the SEC does not imply a certain level of skill or training. The information presented in this podcast is for educational and informational purposes only and should not be construed as personalized investment advice, tax advice, or legal advice, or a recommendation to buy or sell any security. Nothing discussed in this podcast constitutes a solicitation or offer to provide investment advisory services to any person in any jurisdiction where such solicitation or offer would be unlawful under the securities law of such jurisdiction. All information presented is believed to be reliable, but is not guaranteed for accuracy or completeness. All investing involves risk, including the potential loss of principal. Past performance, if mentioned, is not indicative of future results, and no investment strategy can guarantee profit or loss. Any mention of specific securities, investment strategies, or market performance is for illustrative purposes only and should not be considered a recommendation. Economic and market conditions are subject to change, and any opinions expressed are currently only as of the date of this recording. Before making any investment decisions, please consult with a qualified financial professional who can assess your individual circumstances, risk tolerance, and investment objectives. For more information about our services and fees, please refer to our ADV Part 2A, which is available at our website, dowealth.com, or upon request.